Greetings everyone. I'm your facilitator Rajat Kush, and today in this training I'll be talking about forward contracts. This particular training I have divided into two modules. I'm going to keep it very short because this is a micro learning, and here I'm going to cover two topics which will be good enough starting point for you to understand what are forward contracts. So I'm going to talk about basics of the forward contracts, which I'm going to do in this particular topic. And tomorrow, or rather in the next module, we are going to talk about pricing forward contract. How do we price it? And what is a forward rate agreement? So let's start our training. Forward contract is a contract that gives a right to sell or buy an asset. But this is not just a right, it is an obligation as well. So when two parties enter into a contract, both are obligated to fulfill the contract from their side. They will enter into a contract today. They will fix the price today itself, but the actual exchange of the underlying asset and the money is going to happen sometime in future. Okay. This is an OTC product. OTC means over the counter. So since there are two traders, right, they can customize the contract as per their individual needs. So there is no standardization required in a forward contract. Since this is a contract between two parties, of course, it carries counterparty risk. So for example, B was supposed to deliver certain shares and A was supposed to pay certain price for these shares in future. It is very much possible that A might not pay the price, right? So that is a counterparty risk. Forward price uh, may be different from the contracts for different maturities. For example, there's a 1 month forward contract, there's a 2 month forward contract, and there's a 3 month forward contract. Let's say this is an asset A, or let's call it a stock A. The current price of this stock is, let's say, 10 dirhams per share. So its 1 month forward contract might be trading at 10.5, 2 month contract might be trading at 10.6, and 3 month might be trading at 10.9. So different maturities, different forward prices. Please understand that how do we calculate this price? We have to make sure that in today's value, right? In today's term, the contract should be exactly equal to zero. It means neither A should be benefiting, neither B should be benefiting if we took forward price and discounted back to today's value, right? It should not be advantageous to any one of these. Only in future, one of these will make a profit, okay? It can be contrasted with a spot contract, which is an agreement to buy or sell an asset immediately. That is what a spot market is. One party in this contract assumes a long position. Long position means you're buying this product. And the second party is going to assume a short position. That means they are selling the same asset. Okay. Forward contract on a foreign exchange are the most popular forward contracts. If we specifically talk about banks, we trade in huge quantities in the forward market, specifically in currencies. Most banks employ both spot and forward exchange traders. And there is a relationship between forward price and spot price. And this relationship is mainly dependent upon the interest rate between two currencies. Okay. We are going to talk about in detail when we are going to talk about the pricing of a forward contract. Okay, just a simple exercise. Forward price is a delivery price that would make the contract worth exactly what in today's value? Exactly zero. It should not be advantageous to any one single party in today's term. Let's look at a very simple example of delivery based forward contract. There is a farmer who is agreeing with a bread maker that I am going to give you 500 kgs of wheat at this particular price, that is 4 dirhams per kg, after 3 months. Let's call this on 30th June, this delivery is going to happen, right? So you see this contract, all the particulars of this contract have been decided today. But after 3 months, the actual transaction is going to take place. So farmer is going to deliver the wheat and bread maker is going to make the payment. So this is a delivered forward contract. Let's take an example of, let's say, non-delivered forward contract. Okay. Let's say these are the spot and forward prices of GBP USD. Okay. So let's say Bank A is giving these quotes. So Bank A is saying, I am ready to buy GBP by paying this much money for these maturities, and I am ready to sell my GBP if you give me these many dollars for these different maturities. Okay. So now let's forward this example. Let's say there is a corporation in UAE. Let's call this importer. And this importer has imported something from UK. And now this importer has to deliver 1 million pounds in 6 months, right? So now in today's value, if he has to give pounds today itself, all he has to do is buy these pounds by paying these many dollars, right? Buy these many pounds and deliver it to the exporter. But the contract says that the payment is going to happen in future 6 months, right? Now, this UAE company has no idea what the prices are going to be in future, correct? It is very much possible that, let's say, dollar has depreciated against pound, and you have to pay a huge amount of dollars to buy the same amount of pound. So this person or this company wants to hedge the risk. So what they're going to do is they're going to enter into a transaction with the bank for 6 month forward. And what is the price for 6 month forward? 1.3355, right? So this is the quote which they have accepted from the bank. And it has been agreed that after 6 months, this corporation is going to buy 1 million pound from the bank by giving them 1.33 million dollars, right? This is simply 1 million multiplied by this particular quote, right? And since the corporation is buying pound, so by default, they have assumed a long position in this forward contract. And since they have assumed a long position, by default, bank has assumed a short position in this forward contract. Please understand that by law, both sides have made a binding commitment. Okay. So now let's take this example forward. The forward contract now obligates the corporation to buy 1 million pound by paying these many dollars, correct? So if, let's assume the spot exchange rate after 6 months, right, has risen, that means your dollar has depreciated, right? And it has gone down to $1.5 per pound. And let's say this corporation has not done any kind of hedging. So now how much dollars they have to pay to buy same 1 million pounds? $1.5 million they have to pay, right? But since they entered into a forward contract, this forward contract has given this corporation a profit of $164,500, which is nothing but the difference between the spot price minus the forward price multiplied by the quantity, right? So it would enable 1 million pound to be purchased at the exchange rate of this much. Now they have hedged this position, so dollar has gone up. They are not worried at all. That's the point of a forward contract, right? Please understand, hedging means that you want to eliminate the risk, right? You're not looking for profit. So in a second situation, if dollar has gone down or rather appreciated, right? So now if they wouldn't have hedged the position, they would have paid only $1.3 million to purchase same 1 million pound. Got the point? But here, hedging means you want to eliminate the risk. You're not looking for profit, right? And this is why you entered into a forward contract. Another case, let's say ABC Limited expects to receive 1 million pound in 3 months' time. The current spot rate is this much. Let's answer these questions. Is ABC long or short on GBP? Very simple. When you are receiving something, you are long on it. So since they are going to receive GBP 1 million, they are long on pound. What risk does ABC face here? Think about it. Any kind of risk ABC is facing? No, because they have hedged this risk. How can ABC hedge itself? By entering into a forward contract with another party, which in our example was a bank. So if you expect to receive USD 1 million 3 months from today, it means you are long on USD. Think again, you're going to receive. If you're going to receive, as I mentioned before, then it means you are long on USD. So the answer is true. Now let's look at the payoff profile, okay? Now here, let's say someone entered into a 3-month contract on oil future, and the contract price is $50 per barrel. That means they are ready to pay $50 per barrel after 3 months, and they will take the delivery of the oil, correct? Now, after 3 months, if the price is less than 50, of course, they are at a loss. Why? Because as per contract, they still have to pay 50, right? So let's say this party who has to deliver the oil, they're going to purchase oil for $10, and then they're going to deliver the oil to this party for the contract price of $50. So they have made a profit of $40, whereas this company has made a loss of $40. That means if the forward price is less, as in future, the spot price is less than the contract price, the position holder will be at a loss. Break even means no profit, no loss. So after 3 months, if the oil price is exactly 50, no profit, no loss situation. But after 3 months, if the price of oil per barrel is more than $50, that means this position is profitable, right? Let's look at the payoff profile. It's very simple. It's just like buying any stock or bond. You bought at 50. In future, prices went up. You made a profit. You bought at 50. In future, prices went down. You made a loss. So this is a simple formula. Whatever the price is going to be in future, $60 minus your contract price, $50, you are going to make a profit of $10. But if price is less than 50, $40 minus your contract price, you made a loss of $10. So this is a payoff profile for a long position holder. For a short position holder, it is exactly opposite. So you sold at 50, correct? In future, if prices go above 50, that's a loss for you because you could have made more money, but you could not because your contract price is 50. But if in future the contract price is less than 50, that's a profitable situation for you, correct? So the formula is again very simple. Your contract price minus whatever price is there in future. If price is more than the contract price, you made a loss. If price is less than the contract price, you made a profit. So in summary, a forward contract is a contract that gives a right to sell or buy an asset at some future date at a certain price which is agreed today. So all the contractual terms are agreed today. Transaction is going to take place sometime in future. It is an over-the-counter product. It's a very customized contract happening between two parties. But since they are the only two parties involved, both of them are facing counterparty risk. And what should be the forward price? And we are going to delve deeper into forward price calculation in our second module. It is the delivery price, which if you discount back in today's value, it should be exactly zero. That means contract value should be exactly zero in today's value. Hope you found this training interesting, and please stick with me. We'll restart this training with the second module. Thank you so much.